Wayne, thanks for joining me, mate. Really appreciate your time, and would love to jump in hearing a bit of your own just personal background and story, and where you've ended up and what you do day to day.
Thanks, Daniel. I appreciate it. I think it's a good concept. So really happy to be involved. At present, I'm with Forza Capital. I'm the head of capital there. I've been there for about 18 months. It's a really interesting little shop in terms of working with private equity style property investment.
Mm.
It's out of SPVs, doing all syndicates.
Yeah.
We're looking to create a bit more flexibility in that capital base, having some open-ended structures and just giving people more opportunity to work with us. So that's been really interesting. It's got a real family office and ultra high net wealth backdrop to it. Having one of the directors who's responsible for the distribution side, Adam Murchie, who I work alongside, you've got the opportunity to build those relationships over time. So it's been a really, really good move, and I've been enjoying what I've been learning there. Ultimately, it's just a plain speaking, very, very true to label style operation where the guys get their hands dirty, they run hard, and they really do just work hard behind the scenes for investors. In terms of what's taken me here, I grew up in central Queensland originally, went to university in Brisbane, did a little bit of work in private equity there, did some travel, ended up in London for my sins, looking at insurance companies for Goldman Sachs as a stockbroker. I've had a few stints at stockbroking, and looking at insurance companies was certainly an interesting one. One of the things there's probably a couple of things that were really amazing about the time there with Goldman's, just being such a big integrated organization. I was sitting on the research side, I was looking after the client relationships, but then connecting with the sales teams, with the dealing teams, being brought in across the wall with the investment banking side. And there were so many different proprietary pools of capital within Goldman's that you did really need to package the information and the insights that came from the research team differently for those groups. We weren't necessarily the best stock pickers. I think it's fair to say that the team was very strong technically. We had a couple of actuaries there as senior members of the team.
Yeah.
So we were by far the most technical team in our space. And so what that meant was that we had models that would mark to market on a daily basis, interest rate moves, currencies, stock market moves, other bond factors. And we could do that for AXA, Allianz, ING, and 70 other names in the sector overnight. Now, when you got to the GFC and all of a sudden we worked out that European insurers had every bad asset under the sun, they had all the SIDs, the subprime, the CLOs, the CDOs. We could then work with our credit trading desk and actually get really solid information on how those would be marked to market. So when it did come to results, you could actually say, well, the write down is going to either be, $10.5 billion or $11 billion rather than just, putting fingers in the sky. So that was really impressive. And what it meant that through the GFC, as that kicked off, volatility was really high, but it really showed that when you've got and when you actually understand some of those moving parts, and when you've got understanding about some of the moving parts that other people maybe don't know what the actual impact is, even though volatility is off the charts, you can actually navigate that still with a degree of short term. Of course, things would go absolutely crazy, but fundamentals would still assert themselves. So that was really interesting. Got married, lived with my girlfriend over there, came back to Australia. I did a little more travel, and then ended up at Commonwealth Bank in their stockbroking arm as they tried to build out the institutional business. That was a different speed to Goldman's. The one real takeaway there was they did have a nice approach of saying CBA has got more touch points with any other bank or any other business in Australia. So if we can't understand what's happening in different sectors, we can at least get access to people who do. And it's a simple approach, but as part of a distribution team, if you actually know that you're not an expert, but you can put people in touch with experts, I think you can have a lot more value than simply trying to get the answer yourself. So that was an approach that I think Goldman's did that well as well. But with CBA, that was really the core. And being a startup institutional broking business, hired a lot of really good people, but you really did need to have that differentiator for anybody to return your calls. So that was an interesting time. Ultimately, they shuttered that after a few years. But I ended up setting up my own broking firm, which focused on that independent insights. So looking at trying to augment the research that fund managers do by actually getting those industry experts, technical experts, to help fill in some of the blanks when you're analysing listed companies.
Yeah, right.
As is often the case, you end up a client tap you on the shoulder and say if you'd like to do it, work with them full time. And so I worked with L1 Capital for a number of years on the distribution side. They made some interesting transitions from being institutional, long-only equities manager, realizing that concentration risk of having a large part of your capital base controlled by a key few decision makers really spurred them on the journey to see how they can access different pools of capital, how they can get wholesale capital, retail capital. They ended up going to the listed investment market in terms of an LIC. So really just built out the sophistication of their capital base and ultimately diversified the decision makers around that investment decision to as broad a base as possible. So that was an interesting time. There was a period of poor performance whilst they're at L1, and all people in distribution will know that when you are having a tough time, that's the time to over communicate and make sure that you are picking up the phone and in front of people. So that was a period where it was interesting and tricky, but I think a lot of relationships that came out of that are a lot more galvanized now, because once you sort of work in partnership with people and get them through those tough times, it really does mean that those clients value your relationship far more than just organizing road shows and getting them in front of people. And so anyway, that's what's brought me now in terms of Forza Capital, where we're out on the journey, but effectively it's just trying to move down that path of having a more flexible capital base. And that just means that the investment team can keep doing what they do, but hopefully we'll have a broader and a stronger pool of capital to invest on their behalf.
Yeah, great, mate. And being in that kind of private equity real estate sector, it all sits under that sort of umbrella of private markets at the moment, and that's that's popping up every couple of hours in my newsfeed at the moment, thanks to ASIC. Would love to kind of hear your thoughts on, maybe generally what's happening there, but potentially specifically what it means in the world of Forza.
Look, so I think generally it's a shame when we go through these ebbs and flows where you do have to get a review and a regulator really take a look at the sector. Generally speaking, it shouldn't make a huge amount of change for a lot of groups because if you are transparent, if you do actually have an alignment with investors, all of these things are pretty par for the course.
Yeah.
When you've got a huge amount of growth that you've had in areas, and we've talked about in areas like private credit, in terms of trying to find distribution people, there's been such an explosion in the number of operations there that it has really built out that base. So there are groups that have come up as part of that industry growth that maybe don't have the same focus in terms of the governance and how they've actually communicated their offering to investors. One of the things that has been really interesting, I think, is just talking about what the fees paid by investors are for products versus flipping that on and saying, what is the value that's accruing to the investment manager? Because they're really one and the same thing. But if you don't package something as a fee and you're extracting some value at the back end, that's still coming ultimately out of the investment pool.
Yes.
And it is altering the risk. If investors don't know exactly what fees they are being charged on a product, it's actually really difficult to know what the risk that you're taking on for that product is. And so from our perspective, we're very fortunate that we've got a partnership with an institutional grade private debt provider. This is in real estate backed private debt, a group that at present only works with super funds. So we will be a partner that will enable high net wealth investors, wholesale investors, to actually get access to a strategy that they otherwise weren't able to. But for us, it's a really interesting education piece because we're saying that in private debt, that should be a defensive asset. You shouldn't be trying to gain equity returns. That's not to say there's not a place for that, but it goes to duration. You can't get mid-teens returns out of debt at every point in the cycle without taking on some serious risk. You've been able to achieve that over the past few years, and people haven't, seen defaults coming through. And effectively, at every point of the risk curve, it's been a good environment. Whereas over the past 6 or so weeks, you really just the explosion in headlines coming up in terms of projects where people haven't been able to kick the can down the road. So
Yeah.
in general, I'd say that having more transparency in the sector should be a good thing. Making sure that alignment is there between investors and managers, that the conflicts that can be managed are managed better. I think all of those things are going to be broadly positive. And having a fee structure that's understandable, having a fee structure that doesn't create perverse incentives. In the property equity space, we're very much focused on performance fees as being an important driver of what we do.
Yeah.
We shouldn't be paid overs unless investors have really had a good outcome. But it's interesting when you think about things like private debt. The return up front that's what you've got to protect. Not actually, you don't have that equity upside.
Yeah.
You need to return that capital back to investors.
Yeah.
And so when you have a performance fee structure overlaying that, it ultimately does reward high risk taking. And that's, not necessarily what the investor is focused on from that product. Again, different products will have different targets, but if you are looking at that defensive 8 to 10%, net return, you actually don't want to be incentivizing your manager to try and push from 10% to 11. You're wanting them to get the very best out of risk adjusted returns and at that segment. There's a lot of work to come through on that, but ultimately I think it's something that most operators shouldn't be worried about it if their structure passes those sort of common sense pub tests in terms of how they're structured and how they're charging their investors.
Yeah, it's such an interesting point you're making there of people treating private credit as something other than a defensive asset. In essence, it's a lending, so it should sort of be loosely in the same bucket as a corporate bond or a term deposit, slightly up the risk curve perhaps from those. But I guess when you are talking kind of a 10% return as an average, that's roughly an ASX 200 long-term return. So you've probably got to ask some questions about where you're actually sitting on the risk curve.
Well, when we look at the deals that we model up, again, from that very active private equity style property deal, over time, you're looking at about a 15% return that we have put into our investment memorandum. So we've raised the capital saying to investors that we'll deliver a 15% return. Now, post the fact, we've delivered 20, but the
Very
reality
impressive.
is that if you're going into these things with a solid eye to risk, really being focused on capital preservation, you do need certain buffers and insurance in place. And the reality is you just can't push for those maximized returns up front without having a risk impact, corresponding. So it's definitely an area where people have got very comfortable with levels that they won't be able to achieve over the next period. Still an amazing growth industry. We still see it being a larger and larger part. I think there's probably just been a catch-up that needs to take place where so many teams have grown so large so quickly that the principals who've started these private credit firms have just been further and further away from the investment decisions, the asset management decisions. And that just means that there has been, a dilution in the skill set whenever you bring a whole lot of new people into an industry. They're all moving up the curve in terms of their knowledge base. Whereas over this next little period, you're going to need more people with grey hairs that have been through a couple of cycles that really know how people might behave under different levels of stress to be calling the shots in these micro decisions that are ultimately going to be very important in protecting and protecting capital and then maximising the return based on the loan book that you've got.
Yeah, and it's been almost a super cycle of sorts coming off the back of, if you go back to even perhaps the Royal Commission or even before that, equity markets were pretty mediocre in those kind of late 2010s. And so people started looking for sort of markets look pretty ordinary. And then off the back of the Royal Commission, the flood into non-bank lending that couldn't find a home in a bank. And then off the back of COVID, banks are not historically known for being great business partners in a crisis.
Yep.
And so it's been a really interesting, melting pot that has seen this non-bank lending space just explode. And so to your point there, it's like, where are the...
Well, I think that you've got a huge number of teams and businesses that have been built out of the credit departments, out of banks and sort of the more traditional lenders. And one side of the equation is that credit side. It is an important side. But I think what's often overlooked there is you're still making effectively a property investment. Yes, you're investing on the debt side rather than the equity side. But first and foremost, your strongest line of defense is a strong project with good fundamentals that will end up generating a profit margin for the developer, the owner, and then that also creates a buffer that protects the lender. And so there are just a range of projects out there that continue to be financed. You know, if we look at something like high-rise, mass market style apartments, you have groups that maybe aren't used to dealing with projects that large and complex that are suddenly able, from a planning perspective, to upsize the projects that they're working on. You've got land that was bought pre the 22 increases in terms of interest rates. So you've gone through all of the construction cost increases, the other inflation in terms of your financing costs. These things have gone up by 50% each, roughly.
Yeah.
And when you then keep looking back at that same project, you haven't seen adjustments in the land value. So how is that project still stacking up? We've now had another few years of delays. You've been paying off this large interest bill. Where's the equity left? Where's the profit margin left for this project? So transparency goes to a few things. I mean, you can talk about working out what the fees that somebody actually charges is, but transparency in terms of the performance of the assets and how you actually communicate that with investors. There's a lot of issues there that are there to be unpicked. And I think ultimately the thing that we all just need to keep coming back to remembering is that as asset managers, it's not our money. We are custodians, we're fiduciaries for others who put up that risk capital. And so, you know, they need to have a full understanding of both the risk and the reward side of the equation. And over the last few years, it feels in Australia as though that the reward has been such a focus that people don't understand what the profile is to try and get a net 8% versus 10% versus 12% versus 14% return. And again, this is definitely the environment where past returns are not predictive of short-term future returns. You have been able to do that over the past 5 years. I think it's very safe to say it's going to be more challenging in 5 years from now.
Yeah. And so with some of those challenges, you mentioned to me one time that investors are ultimately looking to invest a marginal dollar. What did you kind of mean by that? And how is that impacting the investment decisions you guys are making as you move into this potential change in cycle?
So in terms of the marginal dollar, if you're not aware of exactly where investors are thinking in terms of what's in the portfolio, what's not, actually feel they need to adjust things, you can reach a point where you're trying to introduce a product to them that they're already fully aware of. They may not have liquidity based on other things that are happening in the portfolio. And ultimately, they're trying to diversify into something else. Yeah, it's important to be having those conversations early so that when you've got a new IM out and you're actually launching something, it's not a surprise to you that suddenly actually their focus is going to be elsewhere. But also what it means is that we've seen a lot of groups that on the financial advice side who have had changes within their research teams. They may have lost some capability there. They may have just been changing focus, where things like the single asset property funds just aren't exactly what they're looking for anymore. They don't have the capability to do that short, sharp due diligence and work with a campaign through different investors. And that's why having things like open-ended structures can actually mean that they can continue to participate, they can get exposure to the Forza products, but they don't actually need to review deal by deal and communicate with investors deal by deal. Yeah. So it's just a way that it will work for certain groups in our investor base. Our core base has always been those SPVs, and we will never change for them. We'll always create a structure whereby they can continue to, and we call it the ultimate investor democracy, the fact that you can just review every deal yourself, and if you've already got stuff in the portfolio that feels good, or you think you've got enough in that space, or there's an issue that you don't like about this particular asset, that's great. You're in the driver's seat. But for other people where they do need a slightly accessible and easy to manage product from a client and a platform perspective, we'll look to work with that as well. But it's been interesting the amount of comments that we'll have back with people saying, why would I invest in this project with a potential 16% IRR when I can get 12% risk-free in private debt? And you say, well, there's a lot to unpick there, but we'll talk about each of them in turn. But 12% return on the debt side relative to having potential upside with the equity. There's elements there, but also let's just not even touch on the risk-free point. I'm just going to let that one go through the keeper. But you do need to understand that people are assessing a lot of options out there, and you're one of them.
Yeah. I like that. The ultimate investor democracy. It's going to be one of my new statements.
Well, it was a new space. Yeah, it was new for me to get in this space 18 months ago, and you can be a great investor, you can be a great property investor, but you can still structure it in many different ways for people to access it.
Yeah,
and it's a fairly clunky, fairly sort of slow way to raise capital. But again, you can really see why for those people who actually want to go see the property, do a tour of it, really understand everything about that particular asset, it's a great way for them to get access to it. Yeah. But not everybody's built that way. So we'll just try to make it a little bit more flexible for all parties.
Yeah, nice. And mate, we'd love to, switching gears just a little bit into the general kind of distribution space. One of the conversations I was having just yesterday was actually about how it's a pretty hard space to disrupt from a AI perspective, from a technology perspective, from a software perspective. At the end of the day, relationships are pretty much irreplaceable. And what we're seeing at the moment is a huge influx into kind of this space, be it private credit, be it private equity in the real estate space. And that's kind of soaking up a lot of good BDMs into various places. How are you guys going in terms of I guess, just what you're seeing in that space and what you're seeing in the distribution market and just what are the shifts that you've seen over your, 10-year or so journey in BDM world?
Well, first of all, we're very hand-to-hand. We're very old school. Both Adam and I, we want to be in front of the clients. We want to be able to get around them directly. But having said that, we're looking at ways that we can use AI within our business. It's selective. Ultimately, what we do is really bespoke. And so you can't just pull an IM off the shelf and change the name on the front. The structure of our deals, the way that we approach it, there is a lot of investor education. And that was one of the things that I really about to have to try. Every deal does have to influence. Yes, you can be sure that we're going to be very active managers and that we're going to have a lot of different strategies in place in terms of, game plan A, B, C, D. But ultimately, we really do need to look at, the microcosm of the actual asset that we're looking at. And being able to articulate that really statistically, office has just been a toxic asset class for people in terms of putting new capital to work over the past few years as a result of COVID, the working from home.
Yeah.
I mean, some of the looks that we've gotten when we've taken some really good quality, very attractive, completely repriced assets where people won't even give you 30 seconds to think about it. Now that's fine, but that's also the opportunity. And so part of what we're trying to manage is, in a lot of ways, we're wanting to try and give people what they need, and it may not be what they want. And so when it comes to the deals that we see out there in the market, again, we will have a target IRR that could be 100 to 200 basis points less than what a peer group would have if they were marketing the same property. So there is a big piece to actually explain why the extra capital, why the extra contingency, why all of the modeling that we do and the conservative, the fairly market-based assumptions that we use rather than the fairly heroic assumptions that you do see in the market.
Yeah.
Why we can't just assume that the cap rate's going to fall off a cliff. Yes, there is dysfunction in the market now, and we do think that as market participants come back, you will see natural tightening of those cap rates. But if you're buying property just saying that interest rates are going to fall dramatically, that's kind of a hope-based strategy, which don't tend to play out that way. So with what we're working on, it's trying to find people who actually can understand and articulate risk, who can have a conversation with their group of investors where it's not going to be the shiniest thing that they're presenting, but it's going to be a really well-considered, nuanced offering that is, put together by very credible property players, and that all of the assumptions are backed by us having an actual understanding of, and a true understanding of what it takes to deliver on those assumptions. The team have bought assets that were 90% vacant when you had enormous vacancy rates, and there was nothing magical that they could do to fill that building in that market. But what they did was they say the market rate for incentives might be 30%. We will be going out with 60 or 70% incentives.
Wow.
We will undercut the entire market. We will rebase based on what we've bought our property on, what the market is paying. And we will start ripping tenants out of other buildings, left, right, centre. But we have to pay for that. And that's in our modelling, and that's part of the process. Yeah. So, the guys went from 10% occupied to 100% occupied in a building over about 4 years. They doubled their money on it. Now, when you look back on it, the game plan was incredibly simple. It took a huge amount of execution. I don't want to take away from the amount of tackling that was required to achieve it. But the game plan was actually, you just had to have the courage to say, we are going to dramatically change the level of, the leading value in this market is, but we're going to do that in such a way that we've bought this asset well enough and cheaply enough that we can do it. So in everything that we do, we need to be able to communicate to investors why we can actually reposition an asset and take it to something that it is not today, but that we've got the experience to actually be able to execute on that strategy. And I think you need people that can work without smoke and mirrors. What we do is not that complicated. It's pretty simple. Again, execution is critical, and that takes a lot. But across what the team does, it's caring enough about every little decision. If we've got a little 2 or 3% leasing vacancy there, the team is still going to jump on it when we get a potential, runner on that spot. If there's a way that we can add value in another way, we're going to test various strategies. We're a very curious team. We work a different way. We've looked at things like batteries within buildings and things like that, which I think are probably going above and beyond some of the asset management strategies that other groups will do. But we want to be across it, because if it does make sense, every dollar that we can invest that makes a strong marginal return, again, it's something that it goes both to risk management and optimizing return. You get benefits from both of that, the harder you work an asset. But it's about being able to communicate that as much as possible. Now, if you're working to communicate an open-ended structure that will be a pooled vehicle and you'll have multiple assets, perhaps it becomes a little simpler. It comes down to, this is the team, the credentials, this is what we've done in the past, and this is, why you'd want to back us, as opposed to having to articulate every single asset-specific characteristics. But the reality is we need both, because we are very, very hands-on in terms of what we do.
Yeah.
So it's finding the people that can actually articulate that. But at the same time, it's interesting where, philosophically, when it comes to 400 basis points of rate increases and what that does to valuations, we communicated that really quickly to investors. We took our medicine of the first valuation hits. So at June 2023, that's when we sort of took the knife to valuate. Then in 24, we had a lot of people really nervous about whether or not we'd have another leg down, because that's when everyone else was actually cutting their valuations. But the reality was we'd done it 12 months earlier. There was no extra leg. It was just we acted sooner. So when it does come to communicating some of those tough messages with investors, at least if you're on the front foot and communicating that early, that makes it a lot easier. So, we probably over-communicate with our investors. We probably, tell them too much about what's happening. But at the end of the day, they're partners for a 5 or 7 year time frame in terms of these deals. They need to know what we know at every step of the process.
And it goes back to what you were saying about you take really seriously that you're a custodian of someone else's money, and you're probably just treating your clients how you would want to be treated if you were the investor. And I remember one of my conversations.
To be honest, that's part of it.
Yeah, and I remember one of my conversations with Adam, and he was just saying, like, our goal is to be the most kind of sophisticated in the space. And as we kind of talked about a little bit more, what he really meant by sophisticated was not that it was some complex, very hard to understand private equity strategy. It was a really clear strategy with ferocious commitment to executing and making that thing happen. And it's really interesting. You've just kind of brought up that story of the office building, which just demonstrates that so well. So would love to finish up with any advice for a younger Wayne or a junior BDM out there who's trying to carve their career as a funds management BDM.
I think one of the things that I have appreciated more is I've often just been in a situation where I've been a bit of a lone wolf, and I don't mean that to try and make myself sound cool in the slightest. It's quite the opposite. But I have often not put my head up to see who's in the market and actually understand who I'm either competing against or other people that might be in adjacent areas. And I think, as we've looked to build out the team at Forza and on the distribution side, I think that's something that's probably, been to the detriment. And from my perspective, had I known now, or had I known then what I know now, I think I would have worked a lot more collaboratively with a lot more people where you can trust them in the industry. They're good operators. They might be working in a slightly different fund space. But if they can help with a couple of introductions on their side, I can help them with a couple of introductions. We'll get more market intelligence. It's just something that a lot of groups do, a lot of people do a lot stronger than I do. It's certainly something that I'm looking to do more moving forward. Ultimately, that you can't know everybody in the market. You can't have a strong relationship as you like with everyone in the market. And so that's something that I've often just had my head down, not really been engaged with the recruitment community, not really been looking at what my peers in the space are doing. Whereas I think that's probably been to my detriment in terms of some of the market intel that I could have naturally been working with.
Yeah, great insights, great advice. It's hard when you're junior. You want to see everyone as a competitor that you've got to stay away from and outshine them and outperform them. But there's a lot to be gained in those relationships. Ideally, probably trying to find someone in a slightly different asset class to you might be the way to go, rather than your head-to-head. If you're Aussie equities and they're Aussie equities, then maybe you won't help each other so much. But finding those good relationships with trusted people, I think, is fantastic advice. So, Wayne, that wraps up for today, mate. Thanks so much for your time. For anyone who wants to reach out, Wayne Murray, Forza Capital, Wayne and Adam are a fantastic team there in the cap raising team, and look forward to keeping in touch.